2022 outlooks from Wall Street continue to roll in. JP Morgan chief U.S. economist Michael Feroli is looking for interest rate liftoff from the Fed to begin in September and for the unemployment rate to trek lower. Michael joins us now. Michael, good to see you as always. Thanks for taking the time here. Within your outlook for next year, how many rate hikes are you looking for and why?
So we've actually are now looking for 3 rate hikes, June, September, and December. We do think the pivot here by not only the chair of the Fed, Powell, but the rest of the committee toward an early tapering, or a faster tapering, I should say, is for a reason. And the reason is to get that done with by March so that they can proceed hopefully in a gradual manner to normalize interest rates. But we do think that's the direction they're going in. And I really think the major reason for expecting that and what's really changed over the last 3 to 6 months has been the labor market and just how tight it's become. So we could easily see an unemployment rate below 4% by early next year. And in that kind of environment, having rates near zero just really doesn't make much sense.
Hey, Mike, it's Julie here. It's really interesting that you focus on the labor market side of the equation and not the inflation side of the equation, which has been so much more hotly debated, I think. And also hotly debated is the question of whether the Fed has made a mistake here, right? Whether it should have started moving already in some way. How are you thinking about that question? Do you think the Fed is behind the ball here?
So I think they are behind the ball, but that is almost by design, right? So the Fed, I think they provided the economy with a lot of insurance last year in terms of being very accommodative. Turns out a lot of that insurance wasn't necessary, so that ex post it appears as though it were a policy mistake, but I think ex ante, given the amount of risks that we were facing around this time last year, it did make sense to probably err toward the side of providing more accommodation. Now, I do think you're right that we are focused more on the labor market in part because the price inflation developments we've seen this year, I hate to use this word, but we do think they're going to be mostly transitory and that we shouldn't see the really big price increases that we saw in the second and third quarter going into next year. But when you think in terms of really persistent inflation developments of the type we saw in the 60s and 70s, that has to occur, or that always occurs with a sort of a wage price spiral. And so without wages following suit of higher prices, we don't think this would actually have any legs. But because we do think wage inflation is picking up, that's a reason that this inflation that we've seen this year has the risk of becoming more persistent if the Fed were not to act.
And for lack of a better word, is it the Fed's fault that we have seen inflation pick up as it has? Leaving aside the wage question for just a moment, what we've seen already this year?
I think that would be, I'm not sure I would agree with that. Had the Fed hiked earlier this year, it's not clear that they would have that would have changed much the type of nominal demand growth we saw occur. I think a lot of that was because of the reopening of the economy and the amount of fiscal stimulus provided. So I think, had the Fed acted differently this year, you might have only seen moderately lower inflation, but you would have, I think, risked perhaps worse outcomes in terms of the labor market. So I do think, as I said, they're a little behind the curve, but it's not, they can catch up to the curve. I'm quite sure of that.
Michael, where do you see the unemployment rate going next year?
I think by the end of the year, we could be in the low threes, below 3.5%. That has been really quite stunning how much the unemployment rate has fallen. It's down 1.7 percentage points over the last 5 months. We do expect that pace of decline to slow, but still doesn't take much when you're at 4.2% to get below 4% or even 3.5%. So we do think we could end the year around 3.4%, even with a little bit of a tick up in the labor force participation rate, which has been depressed over the last year and a half.
So, Mike, the picture that you're painting here of this low unemployment rate, of wages starting to go up more, are you expecting to see other types of price gains moderate? And if so, isn't that a pretty robust picture for the economy? In other words, if inflation is coming because people are making more money and things aren't going up at the same rate, like people would seem to have a good amount of spending power, right?
Yeah, I think it is. Look, I think the overall picture for next year is favorable. Now, the inflation we saw in the second and third quarter of this year was really concentrated in consumer goods, and particularly a few categories like autos and a few other things, which seem to be related in part to these bottlenecks that everyone has been talking about. And that we do expect to come off. We're already seeing some evidence that auto production is picking up, some of the chip shortages gradually easing. So I do think it's reasonable to expect some of those goods price inflation to moderate. But we do think, underlying trends in inflation, things like services and rent certainly will be moving higher, but probably not at the same pace that wages are growing. So I do think it's a pretty favorable picture when you think about real wages or overall real disposable spending power, which is kind of the flip side of this year. This year, generally speaking, wages didn't keep up with price gains, and next year we expect a little bit of a payback, if you will, with wages growing faster than prices.
Michael, we've seen a lot of very large companies start to push back their return to office dates for next year because of the pandemic. What have you built that risk in? Is it a risk to your economic outlook?
It is, and I do think we are expecting certainly to see some slowing, notable slowing in the first quarter because of the seasonality of the virus waves, which seems to be, I think, pretty well accepted by now. So we do think that could weigh a little bit on consumer spending in December, January. And we're already starting to see a little bit of that, I think, in some of our Chase card data. So I do think it's reasonable to expect that in what is otherwise a very, very favorable picture for the economy, we are going to have a little bit of a bump in the road here, I think, in the winter months due to the rising case counts that we've been seeing. We would expect that to continue after the Christmas holiday as well. So I do think that maybe it's a little bit of a blemish on what is otherwise a pretty favorable backdrop for the economy.
All right, really enjoyed your work here. Michael Feroli, JP Morgan Chief U.S. Economist. Good to see you. Have a great rest of the week.
Snack food giant Utz Brands releasing its latest retail sales numbers during an investor presentation this week. The company has been seeing higher demand. Sales have been outpacing the broader salty snack category on a 2-year basis. And Utz has also, of course, been making a lot of acquisitions, including a deal with tortilla chip brand R.W. Garcia. It closed just this week. Joining us now, Utz Brands CEO Dylan Lissette. Dylan, it's great to see you as always. We've talked to you a lot about that acquisition strategy and the growth that your company's been seeing. I got to start, though, with what the stock has been doing, because it doesn't seem like investors are getting the message here. You guys have underperformed this year. We have seen a little bit of a bounce off the lows, but what do you think investors have been missing about Utz?
Well, it's, we came out of being a public company and we were a SPAC, and we kind of had this, very far run up to a very high price point. Underlying whatever was happening with the stock price, we were running the business to the best of our ability in a very challenging environment. What we do know is that we continue to see incredible demand for the products. The sales, as you noted, and we just recently shared updated results of retail consumption. The sales, have outpaced in general our ability even to supply the demand in a challenging environment. So we continue to see this increased demand for our products. We're meeting that demand. We're starting to see that grow. Retail consumption is up. The stock price, like you noted, has been ticking up more recently. And, as we look forward into 2022, we're just in a really good spot to continue to grow geographically into the Southeast, into the Midwest, into the West. And as you note, our M&A strategy has been very robust, and we're adding a lot of capabilities and brands and capacity to our network. So as we just look forward into 2022, I think we're going to have a fantastic year.
Dylan, it seems like every day this month we've heard of large companies pushing back their return to office plans. Are you seeing anything in your data that consumers are, starting to restock their pantries, not to the extent they were in 2020, but again, start to restock their pantries as they're going to likely have to work from home longer than they would have liked to?
Well, it's really funny, Brian. We've seen demand really incredible all through the summer. I don't think there's any recent uptick due to Omicron or any of the variants that have come along. The demand has just been really robust. This is for Utz, but for the entire snack industry as well. So maybe that's part of the return to working from home, and some people have moved back into slowing down their return to the office and and working from home. But really, the demand has been there all through the summer, into the holiday season. And as far as we can tell from our conversations with our retail partners, it's going to continue into 2022. So I'm not sure if it's really a migration of folks, no longer being in the office and going home or not, but it's just a really robust environment for all of snacking, to be honest.
And Dylan, we always like to hear from you kind of what's hot at the moment. Where are you seeing particular demand, both in which kind of categories or individual products, and also geographically?
Yeah, geographically for us, I mean, the Southeast, the southern states, Georgia, Alabama, Mississippi, Florida, Texas are very strong for us. The Midwest is very strong for us. But in our core, we're seeing really nice results. In terms of products, the pretzel subcategory has been hot. Variety packs, which is kind of interesting. I'm not sure if that's sort of related to COVID sort of eating habits changing, but variety packs, small bags, and a multi-pack have been incredibly hot from a demand perspective, and that's a really tough one for most manufacturers to deliver, because it takes a little extra added component of labor and effort to put that variety pack together. So those are really some of the areas that we've seen a lot of increased demand in.
Dylan, maybe you can help me explain this one. You license out TGI Fridays, and those products for you have been a strong seller. There you can see it on the board. Why products are still? Do you have other opportunities where you can link up on the licensing front?
Yeah, it's an interesting area. When we acquired Inventure Foods in 2017, one of the brand components to that company was the licensed TGIF. It's really interesting because we're able to take something that has a known brand name, and we're able to add the components of snacking foods, behind it, and utilize our distribution system. If you think about it, On the Border is also a licensed brand as well. And that's grown to well into the 200 million plus retail sales arena. So there's a lot of opportunity and license that that may be in the future for us to consider. But we also like primarily owning our own brands and investing behind those brands primarily first. But a lot of opportunity on both sides.
And anything, of course, Dylan, we learned from today's producer price index, inflation remains a big problem for a lot of companies out there. Have you had to take any price increases, and are you done yet taking any increases if you have taken them?
Yeah, so we've taken pricing, Brian, all throughout 2021. In early 2021, we kind of assumed and were able to look forward into the year and understand that what we thought was going to be, sort of mid-single-digit inflation. I think we called it out around 4%. And it really ended up being at least double that as the year unfolded. So we were taking pricing throughout the year. We just recently took some more pricing. We have a little bit more that we're taking in February of 2022 as well, just as a way to try to stay ahead of all of these cost inputs. There's a lot of cost inputs that go into fuels, edible oils, things that we fry in, components and packaging, labor, et cetera. So we have a lot that we've taken. We have the rollover effect where that'll benefit 2022 more so than 2021, and we've got more coming. So that and a significant focus on productivity and the things that we can use to drive and take cost out and increase our efficiency are big parts of our 2022 plan as we go forward.
We're watching shares of Chinese EV company Xpeng as it gears up for a big slate of innovation in 2022. Despite that, however, shares have been under pressure along with others in the space as Didi plans to delist from the New York Stock Exchange. Joining us now from the New York Stock Exchange to discuss the state of the company and autonomous space is friend of the program, Brian Gu, President and Vice Chairman of Xpeng Motors. Brian, always nice to see you. Normally, you're coming to us from overseas. What brings you to New York City?
Well, after 2 years of, I would say, semi-lockdown, I think we finally able to travel again. I'm so eager to come to the US to see our colleagues, see our friends, our investors, and this is a trip for me to actually meet a lot of my colleagues in person. So I'm very excited to be on the ground here.
Brian, we last talked with you around your Innovation Day, and one thing we didn't get to, we'd love to get to it now though, your Xpilot 4.0. What is that, and when will it start hitting the market?
Well, we unveiled Xpilot 4.0 at our Tech Day. That's a software that will be upgraded by early 2023. This is actually going to be embedded in our fourth product, which is the G9, the premium SUV, when unveiled in the Guangzhou Auto Show last month as well. It will have a brand new architecture with cutting-edge computing chips, from NVIDIA. It also has probably the most extensive sensor packages on a production vehicle. So our goal is to use Xpilot 4.0 to enable end-to-end city-wide NGP, which means that you can basically turn on the autonomous driving capability and drive around the city for most of the scenarios that you see.
Brian, certainly that's not the only electric vehicle that's being sold in China right now. We just got the Chinese auto sales for November for electric vehicles, 427,000 cars. That's 19.5% of the total passenger sales, car sales in China, which is incredible to me. So talk to me about the industry there versus what you're seeing from the industry in the US, where you are in the growth cycle there, and how much for example, the Chinese government has been instrumental in that growth.
Well, this year we certainly saw an explosion of EV penetration. So let's say a year ago, it's roughly 5% penetration. And as the late figure, as you mentioned, is close to 19%. So that's a dramatic increase over the course of probably 15 to 18 months. And this is not just the government policies at work. I think to really move this penetration rate is actually the availability of very good smart EV products coupled with acceptance and also people's actually, the user behaviors that actually welcome these products. Because the subsidy in China actually has come down pretty dramatically from 2 to 3 years ago. And this has become a very small portion of the sales price. But the product right now is selling very well and so on is due to because product strength. At the same time, I think also you saw the infrastructure allowing usage of EV is also blossoming in China. The number of charging stations and also the toll roads and also the city roads are also really geared to welcome more and more EV usages. So the combination of these factors really propelled the conversion in penetration rates.
And I'm also curious, obviously we have seen this global push to address climate change, to bring down emissions. And what you're doing in the electric vehicle industry there is a part of that. How confident are you or are you already seeing a decrease in pollution, for example, in China as a result of this shift?
I think EV industry is definitely a very key component to decarbonization because we are producing zero emission vehicles, but also we actually focus on manufacturing processes starting from the raw material, try to be as green as possible. So that's why if you look at in our plant, we are basically utilizing a lot of these recyclable energies and waste treatment techniques to reduce carbon footprint. So one of the things that we're very proud of is that Xpeng is ranked AA by MSCI in the ESG rating, really reflective the commitment that we have on this energy front.
Brian, I read something recently that Xpeng is rolling out superchargers that will let you charge up your car in about 5 minutes. Is that right? And how many of those will you have in the market next year?
Well, this is actually a part of the technology will be in our fourth product, which is the premium SUV G9, which will be start delivering the second half of next year. It will have the cutting edge powertrain design that enable 480 kilowatt chargings, which actually allows you to charge up to 200 kilometers in about 5 minutes. That requires, obviously, we build new charging piles that is enabled by this technology, which coupled with our automobile battery designs. We are aiming to deliver that experience to our customers by the end of next year.
And we mentioned in the intro, Brian, lots of focus in this space on DD delisting. From an Xpeng standpoint, do you have plans to delist from the New York Stock Exchange?
Well, we don't have plans to delist at all. We still enjoying, I would say, very active trading of our shares in the U.S. Stock market. But we are closely monitoring, obviously, the development of this proposal by the SEC and how in a few years, what exactly will lead to at the end. But as a company, we're fully prepared for any eventualities. We have successfully completed our Hong Kong dual primary listing this summer. So we actually are able to independent trade with or without the New York Stock Exchange listing status. But what I would say is that most of our shareholders are large institutional investors who actually are able to invest in both stock exchanges. So we don't think there will be a lot of problems or issues if there's a change of listing venue.
All right, well, good to see you down there, Brian. Enjoy your trip and time in New York City. Brian Gu, President and Vice Chairman of Xpeng Motors. We'll talk to you soon. All right, the outlook for many commodities prices looks strong next year as the global economy rebounds from the pandemic, says the team over at JP Morgan. Natasha Kanova is JP Morgan's head of global commodities strategy and joins us now. Natasha, nice to see you this morning. Really enjoyed your note. Let's start on oil prices. What's your outlook for next year, and is any relief in sight for prices at the pump?
Good morning, Julie. Good morning, Brian. Thank you for having me again. Yeah, so you're absolutely correct. As economies are recovering and learning to live with COVID that is endemic rather than the pandemic, yes, all the signs says that that's exactly what is happening. We do believe that this combination of wealth accumulation, pent-up demand, still very accommodative policies from the central banks, still very pro-growth fiscal policies, all of that will combine to result in another record level for the energy sector in 2022 and even in 2023. So we do believe that as the economies reopen, oil will be a major beneficiary. Yes, people have money to spend, they have places to go, so there's a significant amount of pent-up demand. So because of that, definitely for us, energy is one of our favorite sectors, exactly as it was in 2021. We do believe that the prices are right now oversold. We do believe that there is higher levels to go. So in general, we're targeting prices closer to $85, $88 for 2022, somewhere between 80 to 85 in 2023. So by all means, we do believe that oil will be a major beneficiary.
Well, why won't rates going higher, Natasha, be more negative for energy prices and more broadly for some of the other commodities you track?
So I think in the case of oil, it's very simple. It's a physical market. And in the case of the physical market, the reality for oil is that 60% of oil is actually moving people and things around. Yes, so as long as people have money to spend and there's a pent-up demand, everybody wants to travel. Yes, for 2 years, you haven't been traveling, you haven't seen your family, you're ready to go. Yes, and that's exactly what we're seeing, the mobility. Right now, if you look at the COVID numbers, they continue increasing every single day, but at the same time, we do not see any slowdown in mobility. Right before our call, I checked the global number of daily flights, and people are not stopping. So, the latest indicators I see is that actually the numbers are up. So, definitely I'm, looking at the statistics about flights being canceled going forward. But again, so far what we see on the ground is that we do not see any slowdown in the mobility indicators. So that's exactly what oil is about. As long as people continue moving and continue driving and flying, that's what will provide boost to the oil demand. So that's number one. In the case of the metals, the pent-up demand is exactly the same. Yes, it's a buying behavior. It's the infrastructure stimulus in China and in the United States. All of that is massively metals intensive. Greenification of the global economies, that's nothing but copper and nickel and other metals. So that's all very beneficiary for the commodities.
And Natasha, I have one more question on energy and specifically sort of gasoline/oil prices, which is people, particularly in the United States, pay a lot of attention to what they're paying at the pump. They like to complain about it. And it is onerous for sure for some people. But what's the dividing line where you start to see demand destruction? Your forecast as you're looking at it for 2022, are we anywhere near that kind of a level?
No, not yet. So I think the price level we're looking at, so $85, $88, we're not going to see a demand destruction at this point. No, it's not high enough. At the same time, definitely what we're seeing right now is that there's a very strong correlation between the unemployment rate and demand. More so that it's, then it really becomes visible, yes, because unemployed people don't have money to spend and don't have money to spend on gasoline and don't travel and so on. So far with the unemployment rate at 4.2% and still a lot of fiscal stimulus and accommodative policies, we're not seeing that feeding through.
Natasha, earlier in the show, we highlighted really strong moves this month in food stocks like a Coca-Cola. Really, it surprised me because ag prices of all kinds, they're still at high levels. What's your outlook for ag prices next year?
So the two favorite sectors on our team is actually energy, that's number one, and the agriculture sector, number two. So a lot of things are happening in the world right now that are very supportive for the agriculture sector in general. Number one is it's definitely the weather. Yes, everything what you're reading, it's, the weather is definitely not supportive for a strong harvest. I would have to say that we still maintain our very constructive view on the agriculture. Number two is what is happening on the oil side. That's all feeding through the oil and gas. Yes, it's all feeding into the fertilizer prices, and that exactly what feeds through the yields, yes, in the agriculture sector. So what we observe on the fertilizer side right now, it's close to record high prices. Not only that, it's very limited amount of availability. So because of that, we have to make downward adjustments to our yield in terms of production, yes, of agricultural commodities, and all of that is feeding through to very low level inventories going into 2022, some extent even 2023. So the way to look at that is that the commodities market are intertwined. Yes, the gas prices are very influential for fertilizer price, which are extremely influential for the agricultural prices. At the same time, the gas prices are influential for the oil prices because of the gas to oil switching and so on. So if you're bullish on one sector, by definition, you have to lift your forecast for the rest of the sectors as well.
Okay, so bullish on ag, but you don't like copper. Why is that?
So it's not that we don't like copper. Copper is one of the metals where we see supply response. The last time we had prices, above $7,000 copper, that was in 2017 and 2018. We saw a significant amount of investment. There was like $30 billion worth of investments and projects that were approved at that time, yes, 2017, 2018. All those projects will be coming on stream now. Actually, they were coming this year, in 2021, 2022, 2023, and 2024. So it's almost 2 million tons in a 20 million ton market that there will be a supply response. Demand is very good. By all means, we see a very significant demand coming through, but at the same time, there is a supply response coming through the market as well. So because of that, in general, our view on copper is we're neutral. The market that we don't like, it's gold. So we held, actually the first time we turned bullish on gold was November 2017 when we advise our clients to buy. We closed this recommendation in July 2020. Since then, we are holding a bearish recommendation on both gold and silver. And the main reason for that is there is a very strong correlation between gold prices and real yields. Yes, and you're absolutely correct, Brian. You covered it in the beginning that the Fed, yes, they're expecting 3 hikes in 2022. That will result in higher real yields, which by definition will lead to a lower gold price. So we're looking at gold prices to average about $1,550 by the end of next year.
We always learn so much talking to you. Natasha Koneva, JP Morgan's head of global commodities strategy. Have a great rest of the holiday season. We'll catch up with you soon. Country's biggest pure-play bowling center, Bolero, is going public today after merging with a SPAC called ISIS Acquisition Corp. The transaction values Bolero at $2.6 billion. Bolero was founded in 1997 when entrepreneur Tom Shannon purchased the original Baltimore Lanes in New York City, which opened in 1938. Today, the company has hundreds of locations opened across the U.S. that offer way more than bowling. Bolero founder and CEO Tom Shannon joins us now from the New York Stock Exchange. Tom, congrats on the debut. I should say, full disclosure, longtime bowler here, so I understand what you do. Take us through the investment thesis on Bolero here.
Okay, great. Well, we are the largest owner and operator of bowling centers in the world, and most people don't know, but bowling is a growing business. The industry's been growing at a steady clip, but our same-store sales over the last 8 years have been growing at more than 5%, which is far beyond most leisure and hospitality businesses. It's a very high margin business. There's no variable cost to 2/3 of our revenue. So bowling and shoes have no cost of goods sold, and that results in about a 50% plus EBITDA margin at the center level, and a mid-40s, let's say, EBITDA margin at the center level. It's very high margin, very high return business. We are 8 times larger than the number 2 bowling player in the world, and yet we only have about 7% US market share. So we have a long runway of growth and fantastic economics that will propel us there.
I mentioned to you in break, Tom, I have several Boleros by me where I live on Long Island, and I noticed on the weekends the parking lots have started to fill back up. What are you seeing right now in the business in terms of sales and profits?
Well, we came way back out of COVID. Once the restrictions were lifted, we saw record sales on a retail basis, up more than 20%. That's the walk-in casual bowler, which is by far the largest share of our revenue segment. So sales are the strongest they've ever been. We've also acquired and built a number of centers in the last 6 months, I think on order of about 30 new locations, and a pipeline of probably 30 more behind that. So record sales. We're doing more volume on a lower cost basis, so our margins have expanded dramatically, and we're growing the business through acquisitions and building new locations.
Hey Tom, it's Julie here, also avid bowler. My mom was a duck pin bowler way back when, although most people don't know what that is. But in any case, on the acquisition front, tell us more about that. As you said, you only have 7% market share in the US. It's a very mom and pop business. How many bowling alleys are you guys going to buy and build in the next year, 2 years, 3 years?
Well, we only have about 7% US market share. There are 3,500 independently owned and operated bowling centers in the US. And so I think that we could easily go from our current, and I think we're right around 320 locations. It's always moving, so it's hard to keep track. I think that number could be 700 in North America in the next 5 years. There are a lot of mom and pop proprietors who are elderly at this point, who are looking to exit. And there's also probably 200 new build opportunities in various markets around North America. So the combination of the two give us a lot of growth vectors.
Tom, at the height of my bowling career, I bowled in a couple leagues a week, and I didn't like to be bothered. I wore a special shirt, very loose fitting, wore the right pants. I just wanted my game to be perfect. I didn't want to be bothered on the lanes by flickering lights. I mean, what do you tell league bowlers like me, as you transition the business to just, I think, broaden your total addressable market? I mean, how do you keep those league fans coming back every week?
Well, the league bowlers bowl in the normal conditions, white light, no music. There are social leagues that bowl with, black light, videos on the walls and music, but those are the minority of the leagues. The traditional leagues still bowl in the normal environment that you probably grew up in and are referencing. So we still do a lot of league business. I think pre-COVID we were doing about $92 million just of league revenue, plus there's ancillary food and beverage. So it's still a meaningful part of our business. We own the Professional Bowlers Association, which is the televised sport bowling that you see on Fox Sports Channel and CBS. And so we've invested a lot in the content and prize funds, et cetera, to really sort of increase viewer awareness and the production quality of the sport. So that's one way that we're showing our commitment to the sport side of bowling, the league side of bowling, is through our ownership and promotion of the PBA.
Tom, how did you get involved in this?
Very randomly. I was invited to a birthday party at a bowling alley in New York. I had moved to New York City after business school, and a girl invited me to her friend's birthday party. And I went down to the original Bowlmore Lanes location on University Place in Greenwich Village. And I looked around and I said, wow. I always loved to bowl as a kid. I thought bowling alleys were cool, but they were pretty run down. Let's face it, they hadn't had a lot of investment in decades. And Bowlmore in Union Square was a great example of that. Literally no investment in decades. And so I bought it. It was actually losing money, which is frankly hard to do given the margins in our business. But it was losing money and actually slated to close. I bought it, I reinvested in it heavily, and we took that one location from $1 million a year in revenue to $15 million in revenue. It was the highest grossing bowling alley in the world for a long time. Became the genesis of the company. Everything that we learned there in our test kitchen, we applied, and it was really the DNA of our footprint, which now is well over 300 locations and growing.
Tom, real quick before I let you go, what's your high game?
236, and it'll never happen again.
Every true bowler knows their high game. We'll leave it there. Bolero founder and CEO Tom Shannon, good to see you. Congrats on the debut.
Welcome back to Yahoo Finance Live. If you're still looking for the perfect stocking stuffer this year, and obviously some of us, myself included, take a while to get gifts, what about giving the gift of crypto? Robinhood is set to launch crypto gift giving on its platform just in time for Christmas, which will allow users to gift Bitcoin, Ethereum, and Dogecoin among a list of other cryptocurrencies this year. And here to discuss that is Christine Brown, Robinhood Crypto COO, the head of crypto at Robinhood. Appreciate you coming on to chat with us again. I mean, gift giving has, I guess, always kind of been a piece of crypto. In fact, I got a gift back in 2014 from my own brother. But what's Robinhood doing differently to kind of make this special for the holidays this year?
Yeah, so you mentioned that it's always been part of crypto. I definitely see that there is a kind of base in tipping and community that crypto is really founded on. Robinhood's all about providing access to investment opportunities. So crypto gifting is a great way for our customers to remove that real emotional and economic barrier of their friends and families taking that first step into crypto. It's also an easy and immediate gift for that person that you know that's already in the crypto space. So we're launching on 12/22. You can send as little as $1 worth of the 7 cryptocurrencies that we have on our platform, including Bitcoin, Ethereum, and Dogecoin. A fun part of this is that you get to personalize it a little bit. So you choose kind of a card, you write a message, you choose the amount and the coin, and you send it directly to your loved ones.
It's a great sentiment, but the business side of me says that this is also an added benefit to Robinhood. Obviously, you're able to get additional users into the fold if you're gifting to those who are already not trading crypto. I mean, how do you anticipate seeing a bump on the back of this? I know we're talking about the sentiment and gift giving, but really in terms of the business case for Robinhood.
Yeah, so I really can't predict the future of what this will do for our business, but we think Robinhood is a great place to do this because we do have 22 million US customers. So there's a lot of people already on our platform. It's an easy and accessible way. And if you're not on our platform, our sign up process is really painless. You can get started in a few minutes, and we have a really intuitive user experience here.
Yeah, no, obviously it's a pretty genius way to on-ramp a lot of people coming from loved ones themselves. So it's pretty trustworthy if you're getting a gift. If they are the crypto savvy individual in your family, I don't know if it goes the other way. If people who don't know anything about crypto are giving crypto, maybe I wouldn't trust my grandpa or something. But if you're looking at maybe, again, to extend the question, sounds like you already had a lot of interest in the wallets that you guys are going to be rolling out in Q1. Last time we chatted, I think it was 1.6 million on the wait list for that. Talk to me about what you've seen there and how the progress is going for wallets next year.
Yeah, we have over 1.6 million users who are excited and eagerly waiting the wallet's rollout. We just wrapped up our alpha program. So we started with an alpha where we brought in a handful of customers and really let them see the product firsthand as we were finishing building it and getting it over the line, giving us early user feedback and sharing their perspectives of what it was like for them. Some of those alpha users were first-time crypto transfer customers. They'd never made an on-chain transaction before, and some of them were veterans. So getting all their feedback of the experience and what they expected, we've closed the alpha and we're going to be rolling out to beta, which will pull folks off of our waitlist in January, and we expect full availability by the end of Q1.
Yeah, and I guess what does that look like in terms of how you differentiate from some of these other platforms out there, right? Because maybe some people, especially as DeFi takes off, they look at some of these centralized exchanges as the on-ramp where they go to exchange fiat for crypto, and then from there they take it, they send it off. Obviously, can't do that on Robinhood unless you have the wallet set up and can do it there. So I mean, how does that maybe change the way you look at what Robinhood offers its clients? Or maybe ways that you'd keep them on the platform if that is something maybe some of the more veteran crypto savvy people might look to do?
Yeah, and this really ties into what we've seen over 2021 with crypto generally. It really has become mainstream, and we've seen customers coming into Robinhood looking specifically for crypto. I think in Q2 we saw 60% of our active or our funded accounts trade crypto, which is like just a very large number, and providing them an on-ramp into the broader DeFi space, right? Turning that crypto from just an investment that can go up or down in price into a utility that they can, take into the ecosystem and use, right? If they want to go buy that NFT that they're eyeing, right? Like this will now be possible with that wallet's rollout that we're managing.
Obviously, it hasn't started yet, this crypto gift giving feature, so maybe a little difficult to have any early insights into which one of these cryptos you might see. But I mean, a lot of people are covering that this is kind of the thing to give this year, just given the fact that crypto has been the 2021 story. I mean, what are you expecting to see once this goes live in terms of adoption, and which one's going to be targeted the most?
Yeah, and the bonus here, Zach, is that you won't have to stress about the supply chain issues when you're thinking of giving this gift in particular. No, I think that we'll see folks using this across different coins. Don't have any predictions quite yet if there's going to be a fan favorite, but it's something that we will be looking at and we will be tracking. We would expect that Robinhood, because we are all about access to investment opportunities, everything from small gifts to larger gifts, we'll see flowing through the platform.
And lastly, as we kind of wrap up, I don't know, I've been feeling very reflective this year. It's been a wild year for a lot of people out there. I'm sure, it's been interesting to look back even at Robinhood this year too. When you look ahead though for crypto in 2022, what are you expecting to see maybe as the biggest storyline that you're going to be tracking following, even larger than Robinhood itself in terms of, I guess, whether or not the year can live up to what we saw this time around?
Yeah, I mean, I wish I had a crystal ball and I could predict the future. But I think one thing that is really trending in the crypto space right now is Web3 and what kind of utility that's going to bring to customers. Our wallet product really will allow us to be part of that and help shape that future. But overall, we've still just scratched the surface when it comes to crypto investing. There's some interesting dynamics here in that, less than a quarter of Americans currently have invested in crypto. So there's still a lot of opportunity for folks to get started and dip their toe in for the first time. And we've also seen in research that folks have a very long-term perspective on this asset. So people are, not just looking for the quick bumps, they're looking at the long game. And so I think it's something that we'll continue to see play out over the next few years.
All right, we'll see how many families out there are putting crypto under the tree. Christine Brown, Robinhood's head of crypto, appreciate you coming back on here to chat with us. Happy holidays. Hope to chat again soon.
Buy your stuff early. That was the message over and over going into this holiday season because of concerns about shortages of gifts going into the holidays because of what we've seen going on with supply chains. Let's get the latest insight into what is going on with those supply chains right now. Lily Shen is the CEO and president of Transfix. It's a company that helps match up stuff with trucks to be more efficient about how the whole process works. Lily, thanks for being here. Before we sort of dig into the bigger supply chain issues, I do want to ask a sort of today question, which is we've been covering the increasing drumbeat and spike in cases that seem to be Omicron from the early indications. Are we set for a repeat, though, of the supply chain issues that had been caused by earlier waves of the pandemic? What kind of early indications are you seeing?
Hi, Julie. Great to see you. I think it's really hard to predict exactly what's going to be happening, obviously, with the cases. So hard to say if there's going to be, if it's going to be a repeat, if it's going to get better, or if it's going to get worse. But what I will say is obviously this has affected everyone, and certainly the supply chain. And obviously, with the supply chain, we continue to see disruptions across the board. But the truth is, Julie, that these challenges in the supply chain have actually existed for decades. Those who were, not familiar with those challenges certainly realize it now. And, a lot of that actually still, in fact, holds true. A third of truck miles continue to be driven empty every single year. And the truth is that the role of technology, which has been huge across so many sectors, it has actually not been the case in transportation and logistics, and it speaks to the opportunity, for those that are in this space today.
Lily, FedEx said something interesting on their earnings call last night that they don't see an end to these bottlenecks in the supply chain. Are you on board with that?
One thing I will say is that in the supply chain, there are constant challenges. And the truth is that there is always going to be some level of demand and supply imbalance. But Transfix's platform seeks to really help our customers as well as carriers manage that through any time of imbalance, through any time of volatility. And obviously, we're continuing to see extreme cases of volatility. But our platform really solves that by doing it in a number of ways. And that's really by providing a many-to-many matching platform for customers as well as carriers who seek to work with us, who are constantly looking for access as well as reliability and capacity, and for those carriers that are also looking for access and reliability in freight. Our platform has really been built over time to be able to manage that, and being able to do that not only with the technology and machine learning algorithms that we have in place, but also with the people, with the industry experts and those who have been in the space and understand and have seen a lot over the years to be able to manage that effectively for the customers that we work with.
So Lily, let's back up a sec. Why are a third of trucks, or if not a third of trucks, a third of the space within trucks, to say that correctly, why is it empty? Why aren't trucks full all the way?
It's a great question. Number of reasons. So one, highly inefficient. So the use of data and technology and the ability to match has really not existed in the past. So we understand exactly where carriers are at, where they're going, and we're able to actually match that with freight that is available at any given point in time. Because the technology and systems have either been non-existent or archaic or actually extremely siloed, no one's been able to really bring that all together. And that actually has driven a lot of the inefficiency that's in the system. So when we say a third of truck miles have been driven empty, it's because of that level of access, data, and visibility that hasn't existed in the industry.
I imagine I'll go ahead, Julie.
The other reason that I want to mention here is that everyone's talking about driver shortage, and so obviously there's a huge opportunity to drive more efficiency in the system. But one thing that continues to also come up is, obviously the number of drivers coming into the system and the ability for every player in the space to also provide better conditions for drivers as well.
I imagine, Lily, you have incredible pricing power in your business right now.
I would say that it's, our algorithms have been built in such a way that, we're able to determine the right price at the right time based on challenges and based on what's working on in the overall system. So, we certainly take a look at where the markets are at, but also, look at the strength of our platform, look at the strength of the available capacity in our platform to be able to help customers and our shippers really best manage their costs.
Lily, thanks for being here. We're going to keep in touch because one thing we didn't mention is you're going to be going public through a SPAC deal that's going to close in the first part of next year. So we'll check back in with you at that point. Lily Shen is the CEO and president of Transfix. Thank you. Appreciate it.